What if I told you there's an investment that turned £100 into millions, while another reliably grew at 8% per year, making it as safe as houses? From property and stocks to bonds, gold and crypto, today I'll give you the ultimate breakdown. After this video, you'll know exactly where your money could grow best, especially if you're based in the UK. So firstly, property. Owning property is embedded deeply in UK investing culture, widely viewed as stable and tangible. But is it really as reliable as they say? So here's the historical returns. UK property prices historically rose about 7.7% per year since 1960, beating inflation comfortably. So here's the pros. Leverage is your first one. Using mortgages to amplify your gains. You also have the rental income, typically around 4 to 5% annually. You also have tax perks. Your main residence is exempt from capital gains tax. The next one is stable demand. Housing remains essential. But here's the cons. It's not very liquid. It can be quite difficult to sell quickly. You also have the management, ongoing maintenance, tenant management. You have high entry costs as well. Large deposits and stamp duty, often between 5 to 8%. And then you also have your taxation, rental income tax at your marginal income tax rate, and your mortgage interest relief is limited to 20%. Here's the risk and passiveness. You have a moderate risk. Market downturns, regional variations. It's moderately active. It's more ideal for investors seeking steady growth and passive income with moderate risks. Next, we have stocks or equities. Stocks essentially mean owning a tiny slice of a real business like Tesco or Apple. Historically, they offer the strongest long-term growth. In terms of its historical returns, UK equities average 7% real annual returns historically. So here's the pros. This does have the highest long-term growth. Stocks historically outperform all major asset classes long-term. You also have dividends, which are reliable passive income, historically 3 to 4% in the FTSE 100. You also have liquidity. You can have instant buying and selling. You have diversification, so it's easily achievable within index funds and ETFs. You have tax efficiency, so ISAs, which can grow tax-free, and pensions or SIPPs offer significant UK tax advantages. But here's the cons. You have a high level of volatility. Short-term market swings can be severe. You also have emotional discipline required. Avoid panic selling during downturns. You have reduced allowances. UK dividend allowance is now just £500. Capital gains allowance is just £3,000 from 2024. Here's the risk and passiveness. Short-term risk is high. Long-term risk is moderate due to market recovery, but it is highly passive if using index funds. This is ideal for long-term growth-focused investors with tolerance for volatility. Next, we have bonds or fixed income. Buying bonds means lending money to governments or companies in exchange for fixed interest payments. Here's the historical returns. UK gilts or government bonds historically are 1 to 3% real returns. Here's the pros. Safety and stability. Lower volatility compared to stocks. You also have regular income and predictable fixed payments. You also have diversification, which is essential in balancing portfolios' volatility. Again, you have tax advantages. UK gilts are exempt from capital gains tax. But here's the cons. They have low growth potential. They typically just beat inflation. You also have the interest rate risk. Bond prices fall when interest rates rise. For example, UK gilts were down 21% in 2022. The interest is also taxed as income unless it's held within an ISA or a pension. Let's talk the risk and passiveness. You have a low to moderate risk on these, but they are very high passiveness, essentially a set and forget. These are ideal for conservative investors prioritizing capital preservation and steady income. Next, we have gold or precious metals. Gold is the oldest store of value, valued as protection against inflation and economic uncertainty. So in terms of its historical returns, historically it's returned 1 to 2% above inflation annually. Let's talk the pros. So it's an inflation hedge. It has been proven to be effective during high inflation periods like the 1970s or 2020 to 2022. It's also a safe haven. It performs well during economic crises. There's also diversification. It has a low correlation to stocks. There's also a UK tax benefit. Britannia and sovereign gold coins are exempt from CGT or capital gains tax. Here's the cons though. There's no yield or cash flow. It doesn't produce dividends or interest. There's also a long underperformance, long flat periods, say between 1980 to 2000, which actually had negative returns. There's also high volatility. Price fluctuations are based on sentiment. You also have storage and insurance costs, which you need to consider if you hold physical gold. So let's talk the risk and passiveness. There's a medium risk due to the price swings, but there is high passiveness. You just need to make sure you hold it securely. This is ideal for investors seeking a hedge against inflation and economic turmoil. Next, let's talk cryptocurrency or digital assets. Crypto like Bitcoin or Ethereum is the newest and riskiest asset class with massive potential gains and losses. So let's talk the historical returns. Bitcoin is the highest returning asset of the past decade, essentially a 230% annualized return since 2011. Here's the pros. You have potentially huge returns. Bitcoin famously rose over 20 million % since 2011. You also have decentralization, which can provide control and global accessibility. It's also innovative tech. Blockchain, DeFi and digital ownership is seen as revolutionary. You also have liquidity because you have 24/7 trading worldwide. But here's the cons. You have extreme volatility, frequent 80% price drops. You also have regulatory risk. UK regulations are evolving, but future changes are uncertain. You also have security risks. They are vulnerable to hacks, theft, and human error. There's also a complex UK taxation. Capital gains tax between 10 and 20%, income tax on earnings, no ISA or pension shelter. Let's talk the risk and passiveness. You have extremely high risk, high volatility, and speculative nature, but there is medium passiveness. It often demands attention due to the market swings. So it's ideal for risk-tolerant investors aiming for outsized returns who can stomach the huge volatility. Next, let's talk alternative investments. Beyond traditional assets, alternative investments are growing in popularity. Collectibles like art and watches have moderate returns, they're illiquid, and they do require specialist knowledge. Private equity are higher potential returns, but they are illiquid, high risk, and usually via specialist funds. You also have REITs, which are real estate investment trusts. They're easily accessible, passive way to own property portfolios with dividend income normally around 4 to 6%. So here's the asset comparison summary. So in terms of building your portfolio, younger investors between 20 to 35 may consider stocks at 60 to 80% of their portfolio, crypto at 5 to 10%, bonds or gold at 10 to 20%. For mid-career investors, say 35 to 50, they may want to have 60% stocks, say 20% property, 15% bonds, and maybe 5 to 10% of gold or crypto. For people approaching retirement age, say 50 plus, they may want 50% bonds or property, 30% of stocks, 10% of gold, and maybe a small allocation of crypto if they desire it. You always want to maximize your £20,000 annual ISA allowance and pension contributions for optimal tax efficiency. No single asset suits everyone. Wise investing is balancing risk, reward, tax efficiency, and personal comfort. Stocks are your engine for long-term wealth. Property is stable growth with passive income. Bonds are reliable protection and steady income. Gold is a crisis protection and inflation hedge. And crypto is a speculative, high-risk, high-reward opportunity. Invest wisely, diversify, and remember wealth building is a marathon, not a sprint. I'd love to know your thoughts. Comment below, which of these assets do you prefer and why? If you found this guide helpful, smash that like button and subscribe to Matchy Does Finance for clear, actionable financial insights every week. Thanks for watching, and I'll see you in the next one.